This is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, March 23rd, 2021. Wanted to get a few more charts out before the close today. This should give me plenty of time to get this one out to you guys, give you my thoughts. Wanted to do an update on a couple things. I believe I missed natural gas on that commodities video earlier today, so I wanted to talk on that. Let's start out with the broad markets. I always say it won't be too long. I'll try to keep this one short. So, S&P 500 continues to hold up relatively well compared to some of the other indexes. What we're seeing here, here's my theme. This is what I'm seeing lately. For quite a while we've had a pretty solid broad-based rally, meaning just about everything was going up, just about everything with a ticker. And what I've seen lately is sector rotation. Now you can view that healthy or not healthy. First of all, what sector? The tech stocks, they were the first to go. And they've had a healthy correction. They've been holding up in the last few days, but again, we'll get to those in just a second. One can argue that it's just a counter trend rally and a bigger correction with more downside to come, or that's it for the tech stocks and it's healthy sector rotation. We go into new highs. So we'll take a look at that. But at the end of the day, when everything's going up, that means you have a lot of money flowing into the market. That's a strong rally. But when you start to see this, sometimes it's healthy consolidation before the next leg up, and at other times it's a sign of a top because the inflows, the money's drying up. So whereas lately, today, for example, they're buying, in the last few days really, they're buying tech stocks because they were beat down. So there's some value there, but guess what? Money's really coming out of the other sectors that I've been bearish on recently, such as energy and financials. I've said the small caps would most likely lead the way down, and we're seeing the small caps get hit hard. So, like I said, that if you want to look at it glass half full, it just says, well, now it's not really as much money coming to the market. We're spinning our wheels now. When something's going up, one or two other things are going down, such as today. So here's the S&P 500 SPY. Down only 0.16. You say not too bad. And again, still holding that 387.81 support right there. I think that's what will trigger the next wave of selling if and when that goes. So pretty much keep it simple. Friday's lows should trigger a drop all the way down to 370.45. I think it'll be a pretty swift drop if we get it. But now let's look at, so again, we're down, again, only about 0.15%, but when I do RSP, the equal weighted S&P 500, see, this is showing what's going on under the hood. Now this is down 1%. So once again, as I said the other day, you take out the impact today that Microsoft up 2%, Amazon up 2.1%, and Alphabet up 1.5%. You strip that away, and the majority of the stocks are down. So I'm watching these big leaders right now. They're giving the S&P 500 a little bit of a false guise of how strong it is or how resilient today, because again, it's these three stocks. You take these three out because of their very heavy weighting, and it tells a much different story. Again, that's what RSP tells us, the equal weighted S&P 500 ETF. And you can also see RSP flirting with this dual support level. So here's a level to watch right here, about 138, we'll call it. Round down, and this uptrend line right here. So you take that out, that's going to be pretty bearish, and will most likely bring RSP down here. Again, the equal weighted S&P 500, take it down to that 132.85 target, which would be about a 4% drop. Probably get a reaction there. If you're going to trade this one, for example, here's how I'd trade it. Wait for the break. Obviously, you want to see some other things breaking down as well, or you want to see the breakdowns, recent breakdowns in the financials stick. But something like that. Go down there, game a quick counter trend bounce if you want. You may or may not get that, or just sit tight and wait for the next leg down to 120.56. And at that point, I think that would be it. That's all I can see at this point in time in the charts. Not to say we couldn't go down anymore. We still haven't visited the 200-day moving average in a long time. Here's the exponential, and there's a simple below it. So just like my thoughts on Spire was a QQQ the other day. I showed you a scenario where you shoot down intraday on a pretty impulsive sell-off, come tag the 200 days, and then come up and park on that price support. So maybe something in there. Let's just call that a swing target range, if you will, for the RSP. And then there's always something for the other side. That's the bearish scenario. And again, I say this so often. A bearish setup is only a setup, an untriggered setup. This needs a sell signal. This needs a break of those dual support levels. As I like to say, support is support until it's taken out. So if you are bullish and you think this is it for the correction, you want to buy the S&P 500 or the equal weighted, you step in right here. It's that dual support, and you go with a stop somewhat below. All right, let's look at some of the others. QQQ. Again, up today because they're buying tech, particularly big tech. We can even look at, let me just see, I haven't even looked today, QQQE. Well, there's the story again. QQQE, put an end of it at the after the Qs, is the equal weighted NASDAQ 100 index fund. So once again, strip out the big, heavy, overweighting on Microsoft and Amazon and Alphabet and Facebook. And here's what you have. You have the NASDAQ 100. If you just put an equal weight on all 100 companies, it is down 0.65%. So no bueno so far. This is what we look at. This is a way of using market breadth or internals. So this is kind of lifts up under the hood, and that's why sometimes a rally or a correction, what you want to see during a end of a correction or a bear market, you want to see improvement in the internals. And that often comes before the end of the correction or early on in a rally. And again, bigger picture, I know we've had these volatile swings lately, and every day I try to do my best when the market's up big, like 3% up or close to it or down, to differentiate between what might feel bullish and what is actually bullish. And what I mean by that is, a big 3% up day or 2.5, whatever percent, is bullish if it breaks resistance. If it breaks above, breaks out of a bullish chart pattern, it breaks above a resistance level. Whereas a 3% rise or fall, if it's between support and resistance, is just noise, in my opinion. So I just want to point that out. So what do we need? We need to see QQQE take out 75.29. It did before, but we whipsawed and we got back above it. So you could say that's bullish. We undercut it, went back above. But again, it was pretty important support. And what I'm looking for now, if we break that, you probably will then go ahead and undercut those recent lows. And same thing, you've got the 200-day simple and exponential moving averages down here about from where we're at now. They're about another almost 10% below. So I still think that's the most likely scenario, another good 10% downside in the market. Potentially more, but we'll see. I'm going to add a level right there for QQQE. Comes in, yeah, that's perfect. You've got these two key reaction highs right there, and then when you consolidate around that level, broke above it, back test it for a little while, that's just like a magnet to me. So I do think that would be an ideal target to reverse cover shorts and even reverse long, whether it's for a bounce or if you think the market's going to new highs and beyond in 2021. We'll just have to wait and see if and when we start to approach that level. How do things look? How does the 60-minute chart look? How do these daily chart looks? This is a trend indicator that has flipped recently to bearish, the PPO, things like that. We go back to QQQ, and then let's not forget the bigger picture, because sometimes it may appear like I'm lost in the world of the 60-minute charts, very short-term stuff, in and out, bounce off this level, go long here. But, the bigger picture is what formulates where, if a stock or an index is falling, pulling back, correcting, and falling down to support, it's my longer term outlook that formulates or helps me decide, do I want to go long at that support level? If I'm short, do I want to cover the short, or do I want to wait and or go long at that point in time for the next leg up? Or do I want to wait for that support level to break because I expect any reaction or any bounce off that level to be very minor, if anything, and then go ahead and short? So that, for example, here's QQQ. There's a little trend line there. There's your moving average. But here's where I'm going with this. This is, if you turn off all the lines, we'll do that now. Some of these lines were already there. Here's what we did on QQQ. We put in the first divergent high, negative divergence, in quite a while. We had one back here leading up to that big fourth quarter drop in 2018. and that was, good. I think it was 20% or so, and we just put in this divergent high. So looking at this, and again, I know there's some powerful underlying bullish fundamentals in the economy right now, market, and they may override these charts. But this looks like the initial leg down with a little kickback rally with more to come. And again, at least down for another visit here of the 200-day moving average. On this chart, it's a weekly time frame we're looking at. You can see it right here. I put it as a 40 period moving average because there are 5 days in a week. So 5 times 40 equals 200. So the 40-week moving average is the same as a 200-day moving average. And it is a level that the NASDAQ 100 and tech stocks just love. It acts as support when you're above it. When you break it, it then is resistance from above. You broke it here. If you missed the, if you didn't want to short near the top when the early 60-minute charts and other trend lines told you to, then you wanted to short right here. You should have held off, and if you did, you waited for a kickback. You had actually one, two, three, four, and finally a good fifth, at least 5 opportunities on the weekly to short the back test of the 200-day moving average or 40-week before the big drop came, the final leg down. And then look, you recovered it here, and guess what happened? Pull back to the 40-week, go long. Pull back to the 40-week, go long. Pull back to the 40-week, tells you the trend's bullish, 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 held. What happened here? You hit it, you got a nice bounce. Don't underestimate how far that bounce went. From the 40-week, it was about an 8.2% bounce. So they bought it, as they almost always do. The algos, the computerized programs, buy orders. Individual investors will often buy pullbacks to the 200. They bought it there, but once it broke, then that's bearish. And again, this correction, this bear market, I believe was artificially, truncated, if you will, by the Fed, cut short with the nuclear options they came in with. But it doesn't matter. I mean, that's what it was. It is what it was. They took it back above the 40-week, and again, we haven't visited that in a long time. Usually, you're going to visit that key moving average during a bull trend every so often, and it's been quite a while. So, again, there it is, guys. I don't want to beat a dead horse, just want to show you that, again, you have the divergences that would indicate that what we've seen so far, that drop from the highs in QQQ, high to low, 12%, that's most likely just the first leg down with more downside to come. Nothing is guaranteed, but that's my outlook. And then IWM, small caps. Just recently I said I believe that small caps, you get more meat on the bone. On a short, they'll likely outperform, and you see that again today, down another 2.7%. And so far, since we put in this divergent high right here, there's your divergence. Here, I'll turn off all the lines, keep it very simple. First divergent high in a while, and pretty big one too at that. And again, this divergence tells me that this little correction is probably not it. Now, sometimes you kick back up, the divergence gets even bigger. That sets the stage for an even bigger drop. IWM is very far away from its 200-day simple or exponential and simple moving averages, and I've shared my targets on this one recently. I think at least we come back in here to that 205 level, which would be both price support as well as a primary trend line off the March lows. So plenty of meat left on the IWM short. I'm pressing that one harder than I am on the other indexes right now. And then, I wanted to show you the futures real quick. Here's where we're at. I added this line today. So this T2 zone's been here for a while. I gave you this target zone up here. I mean, our sell signal was all the way back here. So this is when you broke the uptrend line on the 60-minute chart, just like you had an uptrend line here, nice and clean, just like you had negative divergence. It's almost an identical setup right there. Here, and it was pointed out at the time, we floundered around for a while, kicked back, kept testing around the breakout level, but ultimately worked our way lower. And from high to low off that divergent high, that was about a 11% drop right there. And so far, we haven't even fallen that much yet. There was our sell signal. We've been zigzagging lower. We hit T1 right here. At this point, T1 danced on it for a while and then took it out, and that opened the door to this next leg down. There's potential divergence, but if we go much lower, it's going to be taken out. We're going to move through and no longer have the divergence there. And I'm leaning that way. I think my second target zone will be hit and possibly more. I just, again, spent a lot of time looking at the daily chart, showing you some, additional, longer term, potentially longer term, lower targets. So how to trade it, if you want to, you can just trail a stop down, or periodically ratchet your stops down. You can use these reaction highs as stop points if you take those out, or a certain percent. But I can tell you this: if you're running a 1 or 2% trailing stop on RTY or IWM, you're going to get clipped out in the noise. The volatility, day-to-day grinds and back and forth, even within a trend, are usually going to be more than 2%. So you need to really, if you want to try to capture the big move, you need to use a wider stop, somewhere 5-8%, maybe in that range, maybe even longer or higher. And or do what I like to do, micromanage off these levels. When that level's broken, you can add, start increase your position. When you took out the recent, as we did, took out the recent lows, you get that next leg down. And then when you come up on support, either tighten up stops, tighten up your trailing stops or hard stop, and or take some off the table and then try to, maybe add back on a counter trend bounce. There's that trend line I pointed out the other day. It's still intact right there. There's a downtrend line that ideally, IWM should respect and stay below, at least until we hit that second target zone. Okay, there's NG. NG pointed out, just was it yesterday, is a long trading up. It took out the downtrend line, and right now it's backtesting. We're actually backtesting. We have a confluence of support here. We have the minor uptrend line off the recent lows. You have the downtrend line, which we're backtesting. And just below that, and this really we need to remain above there. This one's probably going to have another leg down. Is support around 248. So you can either have a relatively tight stop. Again, if you've traded natural gas before, I don't have to tell you this. This is the most volatile commodity that I'm aware of. And again, if you're trying to use 1-2% stops, it's just too tight. You need to give natural gas a little room. And how do you do it without getting wiped out? If you're giving yourself a 10+% stop loss, well, you don't take a very big position size because it doesn't take much to capture. When you swing trade these trends, this divergent low, that rally up there, that was 35%. This divergent high, that drop down there was 16%. So the trends, even just little relatively minor micro trends within the larger trend, are big enough that the gain potential and loss potential is very high. So again, that's the trick, in my opinion, is don't put half your portfolio or a quarter or 10% into this one. Put less into this than you would into something like gold, for example, or treasury bonds. And speaking of that, I said gold. I didn't like today. It was no bueno. The fact gold took out that triangle pattern. So nothing huge so far, but it did take out that minor uptrend line. We're still well above the lows, but you might want to hold off adding right here. And if it takes out that 1706 level, that's not going to be good. But that's the next support. So if it can hold that and move on up, great. There's your next resistance target. It was already hit once, so we need to break 1757 to open the door for the next leg up. If we take out 1706, it might give us that scenario of a marginal new low before we end up reversing and putting in a sustained rally that has some legs. Okay, I posted a chart of crude on the home page. I just want to do a quick update. This is our primary trend line. It goes to the left of the chart here. I zoomed in a little bit just to show you we have potential divergence there, but it's only what I call potential. What's the difference? Well, confirmed divergence would be if we rallied here enough to turn the indicators back up and give us a bullish crossover, because that would effectively put in a higher low on the PPO. That's what I look for to confirm divergence, because these are momentum indicators, and right now the momentum is down. We're headed down. We're in a downtrend. And if they keep going lower, then guess what? You don't have divergence anymore. So that's also minor support at 57.25. So I expected a minor reaction there, and so far that's what we had. We hit it. You can't see here. If I zoom down to a 1-minute chart, here, I'll do that for you. You can see that we bounced around it. See, boom, we hit it, and we've been consolidating. That's a reaction. A reaction comes in the form of either a bounce and or a consolidation. We were on a 120-minute chart. Let's go back to that. And just want to point out that if the market takes another leg down, I'm waiting for these charts to load. If the market takes another leg down, which I still think is likely, that's probably going to bring crude back down here. Um, you know, my convictions aren't super strong, but that's a pretty darn good support zone, and that is better support right there, 53.84 than this level here. But this, again, this is support, and the way it works, if that's taken out, especially impulsively, we'll probably come on down to that 53.84 level, and I would say probably equal odds whether that ends the correction, or at least before a tradable bounce, or maybe down to the bottom there at 51.81, because they're both about equal as far as how well defined they are, because that was a trading range. So boom, 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 bounce around. That's the top of the trading range there, and the bottom. Okay, now let's just talk sectors real quick, and then we'll wrap it up. XLE pounded the table on that, as liking it back here. We had a pullback trade, and I said if and when it got up here, that'd be even a better level, because that's even bigger resistance. And you can see here on XLE the energy sector, and boom, that was it. So we had 1, 2, 3, 4, 5, 6 days of it testing 53.61. Couldn't do it, gave up the ghost. So you could have shorted at resistance, and or when the trend line broke. It was a beautiful, very well defined trend line. There was your sell signal, that red candle right there. And XLE has not looked back since. It's dropped about, I know it's got to be a good 10%. Let me try to measure from the high there. 12% so far, down to the first target around 47. Remember, these are actual support levels. You want to cover a little bit above where the actual support level is. Sometimes if all eyes are looking at that level, the buyers may step in early if that's your preferred target. But I don't know. We could well, look, let me say this. If crude takes out the lows and moves down to the next support level, which I'm leaning towards, then XLE will most likely as well, and that'll bring us down to the 45.30 level. If things get really ugly, this level here. And that's about all I'd be looking at right now at this point in time, 42. So again, we're at the first target, and this is how this works. That could be the end of the correction, but it doesn't appear so. Corrections are usually not just this quick one and done. They can be, but with this was a correction within just an uptrend. But this one, we had a nice sell signal of a bearish rising wedge pattern. So you did have a pullback there with another leg up. But again, there was no sell signal, or I don't recall there being one at that time. We had a rally into resistance. That was about it. Now we have the big divergent high and everything else. So I think we can work our way down a little bit more. And then, as I said, I like XOP and XLE. If you get the call right on the energy sector, you usually get more bang for your buck in these subsectors. This is the oil and gas exploration and production. XLE is big oil, mostly big oil. Chevron and ExxonMobil make up almost, last I checked, and they might have changed, it was over half of that ETF. So here's XOP. So far off the highs right there, that divergent high has dropped 15%, so you can see more downside. Took out the 80.35 target, hit that level, bounced on it a few days, took it out now, and that opens the door to move down to 72, next target. And that's a pretty good area to cover. I think if you're long drip, which is the inverse of this, 2-time leverage inverse, or your short XOP, we'll probably get a decent reaction off that level. And again, this could be it, because the XLE's at support, crude's at support. And so, the way to do it, if you can set a stop and let it run if you're holding out for that level, just in case we kick back and the whole correction's over. XES. This one, of course, even more so. This is probably the most, well, usually is the most volatile, meaning if the energy sector is rallying, this one usually will outperform. And when it drops, this one tends to go down more. It's down 22.5% since that divergent high. Just a nice, clean, beautiful sell signal there. Rally into resistance at 64.30. Overbought, negative divergence, everything I like to see. Sell signal with a big red candle, and it hasn't looked back yet. And it's also taken out support. It went right, smashed right through that 55.44 support with a big red candle today, a big drop. So I think this one's also headed to that next target, about 47.75 right there. And that's where I'd expect a reaction if and when we get there. And just remember, things happen fast during corrections. Stocks tend to fall faster than they rise often. So, we could hit that tomorrow, possibly. And other than energy, the two sectors I've been most bearish on just recently. First, energy, because we hit that first, the resistance, and then XLF. I was waiting for the a sell signal to come on a break of the bearish rising wedge. That's these two lines. Got it there the other day. I think it was Friday, and nothing but red sticks so far. 32.83 remains my first and minimum target, and I do think this one, especially if we see some other sectors roll over, has a lot more potential. So on this one, I'd be apt to trail stops down. FA, I don't know if it's still around. There were a couple of them. FAZ, it's been a while since I traded. A lot of these three-time, it used to be three-time. They either blew up or they went down to two-time leverage. So you can see if FAZ is still around, and then SKF was one of the first to market inverse two-time leveraged short financials. Otherwise, and that's for people that can't short. Or, for example, you want to do it in an IRA or something like that. You can buy these three-time or two-time leverage. But again, check, make sure. Sometimes I'll tell you it's three-time, and then the company recently, you know, in recent years with all the volatility, a lot of the three-time leverage ETFs blew up or couldn't maintain that leverage ratio and either went away all completely or they reduced their leverage factor. Nugget and Dust is one example of that. The gold mining ETFs used to be 300% leverage, and now they're only 200, and quite a few others. So that's that. All right, there's your targets and potential targets on XLF and potential or alternative trading proxies for you. And then last but not least, since we're hitting on sectors, actually I'm going to cover airlines, but XBI, just a quick update. I gave you a post. Somebody asked about XBI. A couple of members asked about that last week, and so you had the divergent high here, trend line break, and again, this is what a correction after a divergent high tends to look like in waves. Wave one down, counter trend rally, and if we take out that 139.60 support, we'll briefly undercut it. That should open the door for a drop down to that 122.43 level, which I'm favoring right now. Trend indicator has crossed down below the yellow line here, indicating that the trend has flipped from bullish, since it's been right here all along, bullish, 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 holding above there, to bearish. So we could even get more than that. And what I showed you on there was also a potential head and shoulders topping pattern. I said the strategy on that, when you see what appears to be taking the form of a head and shoulders, the conventional method, if you read the textbooks, will say, well, that's a pattern, and you wait for a formation of the right shoulder, and then your trigger is a break of the neckline. That's this line right here. I like to see a right shoulder form, and if it aligns with what I'm seeing in the sector, in the market, and elsewhere, and a lot of the individual stocks in that sector, I'll take a short once that right shoulder appears to have topped it with a stop just above it, or not too far above it. Give it room. Not again. You want somewhat symmetry. It doesn't have to be perfect symmetry. It rarely is perfect. And then you get a much better entry point. So what you can do is you have a partial position there. You want to see an impulsive move down to the neckline, and then at that point you can wait for a break of the neckline and take it up to a full position. That's your measured target down there on XBI, by the way, all the way down to about 104. But again, I give you targets here, and I'd be covering most certainly at about 108 instead of 104, because that's pretty good support right there. Worst case scenario, I think right now, if we get a bloodbath type, pretty hard correction, I should say, is a drop to about 97.90. That would be my max target. And again, I'm not calling for that target at this time, because I have to see some other sectors roll over. The S&P 500 is still not far off all-time highs. Okay, last but not least, airlines. They've been high flying. I kind of just sat back, watched. Everybody, yeah, COVID, the vaccines are working great. The planes are starting to fly. I get it. But, they're back to where they were pre-COVID levels. After a year of, suffering tremendous losses, sucking on the government teat with aid and all that I don't know. I haven't looked into this sector. I'm not a fundamental analysis is not my primary thing, but I bet if I did, there's probably some money that needs to be paid back. And so, how much of that's priced in? Should the airlines really be above where they were for years leading up to the big drop before the COVID lows? I don't think so, but I don't care. What I can tell you definitively, we can sit there and debate fundamentals all day long, is that is a solid resistance level, 112.51, and an impulsive rejection off it so far. and negative divergence and overbought running into it to boot. So, I think this correction, the airline's just getting going here. And where does it go? Right there. I think 89.52. And again, that's the sector itself. You can, sit there and look at all the individual airlines, Southwest, Delta, same thing. I had resistance here. I haven't updated any of these charts in a while. I just noticed the airline sector the other day, XAL hit that level, but they all look very similar. You could here extend. There you go. There's Delta. Hasn't even broken down below the primary trend line yet. If it does, 3860 is my target, for example. So if you're, bullish the airlines, you want to get into them. I'd wait for here. I'd short them down to 3760 and go long. And or if you don't short, that's a objective place to go long. Just not here. You just hit resistance and you're just coming off it. And I can go down the line. They all probably look similar. UAL resistance, same thing. Ryanair. And then there's some bunch of them out here. Again, the charts are messy. I haven't updated them in a long time. So let me wrap it up here. All right. That's enough sectors. I covered natural gas, gold, pretty much everything I wanted to get to. All right, guys. I'm going to wrap it up here, get the video out to you guys in time for the close. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.